down 50% in 2022. Is ChargePoint stock a buy for 2023? I'm going to answer that question in this video, so stay tuned. The first thing I'm going to look at is quarterly revenue growth for this electric vehicle charging station and software provider. Of course, the EV industry is exploding, and it seems like every government in the world is trying to encourage development of electric vehicles, incentivizing its development and growth. And so ChargePoint stands to benefit from that industry growth. And in its most recent quarter, revenue came in at 92.7%. So incredible top line growth that I expect to persist over several quarters more. So growth, at least revenue growth, is not a concern for ChargePoint investors. What's more of a problem is looking at its operating income or profitability. So yes, it can grow the top line as more businesses, enterprises are ordering ChargePoint to, put one of its charging stations in its business, in its parking lot, in it, maybe it's a big apartment complex, they want a couple of these in there. Whatever the case might be, demand from customers is high. However, the company is still not able to run the business sustainably, and the losses are only getting worse. In the most recent quarter, down to 83 million, and it's going in the wrong direction. As its revenue is growing, its operating losses are increasing. It should be the other way around. As your revenue grows, you should be able to leverage some of your fixed costs and start delivering some kind of profit expansion. Or if you're still losing money on the bottom line, at least to have those losses shrinking as revenue grows. But ChargePoint is going in the other direction. Its losses are growing as its revenue is growing. I don't like to see this from my investments. The next thing I want to look at is cash flow from operations, and that's moving in the same direction as operating income, losing money with each and every quarter, and those losses are getting worse. It lost 83 million in its most recent quarter. And I also want to look at shareholder dilution with these young companies. Sometimes they're paying their employees with stock-based compensation, and that's diluting shareholders. And this is not such a big problem for ChargePoint. It's started with 280 million shares outstanding, growing to 340 million shares in the last, I want to say, 2 to 3 years. So about 8% shareholder dilution per year for a company that's growing the top line as quickly as ChargePoint is. This isn't troubling in and of itself. What is troubling is the downward direction of its cash flow from operations and its operating profitability as revenue is growing. That's a more troubling sign than any of the other metrics that we've looked at. And so finally, let's look at its valuation to determine if ChargePoint stock is a buy for 2023. And it's trading at a valuation of 8.5 price to sales. Since it's not consistently profitable on the bottom line, nor is it generating consistent cash flow from operations, I chose to use the price to sales ratio. Relatively speaking, it's the least expensive it has traded for according to this metric at 8.5. It was at one point trading at a price to sales of 75, almost 10 times as high as what it is now. But that was at the prime of, the hype around the electric vehicle industry. Anything that was associated with EVs in 2021 seemed to be skyrocketing, unjustifiably so in my opinion. And even at a price to sales of 8.5, with the profit margins and cash flow from operations moving in the opposite direction, I would say the stock is not a buy for 2023. So it's important for investors to be able to separate these two things, right? Yes, ChargePoint is in an industry, the electric vehicle industry, that's growing rapidly, and it's got many, many, many years of growth ahead of it, right? You can acknowledge that fact and at the same time say that, hey, that excellent prospect in the future may already be priced into the valuation, and even more so, right? So investors are already more than justifiably pricing in all of the excellent prospects this company has in the future, right? So that's already into the valuation, trading at a price to sales of 8.5 when the company is moving in the downward direction in terms of operating income and cash flow from operations. So not taking anything away from the company's future prospects, which I think it's got many quarters and perhaps many years of solid top line revenue growth ahead. But will it ever turn profitable? Will it ever start generating positive cash flow from operations? That remains to be seen. So for now, I would say the stock is not a buy. All right, thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.